So it's my pleasure. It's my pleasure today to introduce Nick Avery of Finclear and Chris Wrightson of Ironbark. Both organisations will be known to many of you. Finclear through its role as a broker and market participant, Ironbark as a diversified financial services organisation involving both investment management and ownership of advice businesses. Nick and Chris are going to be talking today about the role of managed accounts in advice practices. So first we might start off, Nick, we're talking a little about Finclear's involvement and its business model.
Yep. Okay. So first and foremost, Finclear is a ASX market participant, as Toby elaborated on. ASX market participant and clearing participant. So we provide execution and clearing services for financial planners, wealth managers, and stockbrokers, as well as some fintechs that are coming to market at the moment. Through the evolution of that, most of clients' assets that we manage sit on HIN, and we've actually developed out a managed account solution that is HIN based. So it actually differs from the usual solutions that sit out there, which are obviously custodial or sit on the larger platforms. Now, some of the limitations with that is we don't actually offer things like managed funds or anything like that. They are pure equity models, and they're domestic equities, which we offer in our managed account solutions. All assets are actually held on a HIN. So with that HIN solution, it means that the assets are transferable between the client and another account they may have. Or that client can actually, they have full visibility through to the share registry, so they can actually look at their holdings, real time look at them. They're not held in that custodial model and layer. And that allows the advisors to sort of present something to clients that they can actually say that they can sort of touch and feel, for better lack of a term.
Chris, tell us about Ironbark's involvement in managed accounts.
Thanks, Toby. Well, many of the audience probably know Ironbark as an asset manager, and we have an institutional and wholesale asset management business, but we're also an RE for our funds, and that RE role we take to market and assist advice businesses to build managed accounts. So practices would typically come to us with a desire to build some sort of managed account capability for reasons we'll obviously talk about, and we facilitate that for AFSL's advice businesses. We also obviously have a few equity stakes in large-scale advisory groups that are growing by acquisition.
So what are advice practices in those that you deal with? What have they been looking to achieve in building a managed account service?
So I think practices come to us for four key reasons when they think about managed accounts. One is growth, another is efficiency, risk management and compliance. So the growth element is probably two parts. One is if they're growing their client base, adding more and more clients, it actually gets harder and harder to provide updated portfolio rebalancing when you've got hundreds or perhaps 1,000 or more clients using the regulatory approach of an SOA and an ROA. And that's where you get to the efficiency play. If you've already got 500 or 1,000 clients, you're probably finding it pretty hard to communicate, update portfolios, rebalance, and so on in this particular time. A managed account brings greater risk management into a business. You get clients that adopt a managed account portfolio get quite rigorous approach to the investment management and execution of trades and rebalancing and so forth, because it's automated to some extent. Once the investment committee's made its decisions, it gets executed for all clients. So you remove, some of the risk management around human error and transaction error and that sort of thing on a client-by-client basis. And it aids compliance.
Yeah. And Nick, for obviously practices to deal with you have to have a direct equities ASX orientation. What are they looking to achieve in working with you to build a managed account?
Predominantly, most of the clients that use our managed account solution have SMSF clients, because we don't run an RE trustee structure, so we don't look after the retail super space. So in that sense, having a subset of underlying clients Not too different to what Chris said. They're actually looking for efficiencies, compliance, and trading second to that. So where we look at other platforms, they may send trading or batch trading, etc. They're actually relying on a third party. Our offering, we do everything from start to finish. Our only reliance is obviously the investment manager that sits off to the side. They make the decisions on the portfolios. Those portfolio rebalances go through, they feed through to Finclear, and then Finclear execute those trades. So for that, it actually removes that sort of objection or sort of piece from the advisor's business model, I suppose, where they have to actually, if there's a change in, switch in portfolio, selling BHP, buying, Rio, whatever it may be, they would then have to then do that across their underlying client base, which if they're doing trades one by one, ROAs, SOAs, all the rest of it, that would actually be very time consuming. We then look at things like corporate actions. Corporate actions could actually sort of stop a financial planning firm in their tracks for a week if something comes up, where they're having to actually assess the corporate action, deal with their research team, research house, or outsourced investment committee, and then have to make a decision on what they do in that sense, and then having to present ROAs, etc., back to clients and get collated feedback through those, and then submitting that back to registries or trading those positions.
So those are very much efficiency-driven arguments. I guess the question it leads itself to then, and certainly one which has been much in my mind, is what benefits this is Chris or Nick, what benefits are advice businesses looking to deliver to clients? So what benefits are they looking to achieve for clients in going down this path?
I think when practices come to us, they're often in a position where they've run portfolios in a particular way, often using managed funds for the implementation. And so they've been the portfolio manager, really, for all of their clients. And what they're looking to achieve for clients is the ability to manage those portfolios and update those portfolios and rebalance those portfolios on an ongoing basis in a more efficient way for the practice, but at a better level of execution for the client. In other words, if their investment committee was to meet every couple of months and something needed rebalancing or something needed changing, they can execute it there and then for the hundreds or thousands of clients that they have. And so there's a real client benefit that comes out of it. I think the other thing that comes out of it is when you go down this track, you end up managing money on almost a wholesale basis. So you're able to go to fund managers, if that's your particular business model, and negotiate lower funds management fees on each asset class, each type of portfolio. So you are able to reduce cost to client quite dramatically by operating as, in effect, a wholesale distributor for your clients.
I mean, Nick, that particular issue wouldn't necessarily be available to you. But,
no, definitely not. I mean, look, one of our benefits, our proposition is probably a little bit unique. We actually charge zero brokerage on our rebalancing and execution. We're able to do that because we own the value chain from start to finish. So that actually delivers an end benefit to the client, which advisors like, because each time a rebalance happens, the end client isn't paying brokerage on that rebalance. It's all netted out in just a single fee structure. But not too different to what Chris said. I think advisors look for that efficiency piece, but it also allows the advisor to deliver actual advice to the client rather than bugging them once a week, once a month on rebalances and do you want to do this change? Do you want to do that change? Do you want to buy this? Do you want to buy that? The advisor or the client pays the advisor for the advice they're delivering. And this allows both the client to step away and actually allow the advisor to do what they're paid for, and not obviously be involved daily and have to make a decision on the fly every time there is a change to portfolio.
I know I've, in some of the reading I've done recently, there's been quite a bit of speculation about upcoming corporate actions, capital raisings and such like. And I guess this represents an opportunity for those sorts of decisions to be made at a portfolio level rather than a client by client level.
Yeah, correct. Yeah, I think, look, there's obviously talk, I mean, ASIC sort of relaxed the rules a bit around capital raises and what is required to actually raise that capital in the current pandemic. So they will come through, but it does, yeah. I mean, if we see more and more capital raises that come through in the coming months, that's obviously going to add more stress to financial planning businesses that aren't running managed account solutions, that are purely doing equity portfolios. and having to update clients every time there is a capital raise that comes through.
Okay, so let's talk about a practice, either a licensee or a practice within a license, who say, right, sounds good to me, I want to move to a managed account world. What is the process that in your experience, or Chris, for them to be acceptable to you, they would then have to go through?
So I think when practices arrive here, they know broadly the benefits, but they're probably not sure about what the process is. And I think it starts with, well, I know it starts with where are they currently placed with regards to their clients, the money invested. Are they a portfolio manager, or are they an investment manager as well? Are they conducting trades in securities? So there's a process to go through around where are you now, and then what are you trying to achieve? And through that, there are steps around the build and design, the setup of a more structured investment committee for many of them. Sometimes it's the hiring of a third-party consultants to sit on that investment committee, all the things that ASIC are pretty keen to see, as we understand, which is about, if you're going to manage money or be a portfolio manager, do you have the right people with the right experience sitting at the table? And then there's the regulatory side of it. So if you're building a separately managed account, it's actually captured as a managed investment scheme. So there's registering that with ASIC, PDS. So they're all the things that we do with a client when they come to the door and sort of say, well, we want to build one of these things. We kind of manage that build process and design and implementation for them.
And Nick, what about you? I mean, in the sense that you're running an off-platform world, what's the process that a practice or an advice business is going through?
Yeah, look, I mean, we have a couple of solutions that we offer advisors. First and foremost, the probably most popular one is we have Lonsec, to name one, investment management group. So they're actually the investment manager. They build and construct the portfolios, and then they make the actual portfolio changes. So the advice business is simply coming in, putting their clients into the managed account solution and relying on Lonsec as the third party or outsourced investment manager to actually do those changes or sort of recommend those changes on those portfolios. That allows those advisors to then concentrate on their clients on other things like goals-based advice, insurance, and everything else. We do have others that have come through lately, and we've actually had a sort of a spike in inquiries, believe it or not, in the current pandemic, market fluctuations and stuff. So a lot of sort of just doing that sounding piece where they're coming to us and saying, look, we're thinking about doing managed accounts. What does it look like from a HIN perspective? And again, most of the people that come to us are predominantly, they've held equity positions in client portfolios for many years. They do bespoke changes on individual client portfolios, or they rely on third-party research, such as a Lonsec or a Morningstar, to actually make those recommendations. So we can package up solutions, whether it be a total just outsourced solution, which is they come in, take it or leave it as it is, as a Lonsec bespoke Lonsec model. Or we are starting to work with other practices to work out exactly what they're trying to achieve in their managed account solution, and can we come up with something where Finclear sits as the MDA provider or operator, and we make sure that they have the underlying compliance and experience and expertise in that investment management process, and actually ability to manage those portfolios on more a wholesale basis.
Now, before we go on to the attendees of today's session, if you scroll down to the bottom of the screen, you'll see a set of icons come up. There's a Q&A icon there. If you have a question for any of our panelists today, Nick or Chris now, David Bassanese next, or Lucas or Shane, type in the question and we'll see that question pop up on the screen and deal with it as appropriate. Okay, so for both of you, I imagine that this issue that ASIC has made clear of wanting to see adequate investment expertise in the way in which portfolios are managed is a critical part of a managed account program. Do you have internal kind of standards or an internal due diligence process which essentially assesses that investment management capability?
For Ironbark, we most often look at, well, what's currently in place. So some practices come to us already having hired a Zenith or a Lonsec, and therefore they have third-party expertise on their investment committee. We look at the makeup of their investment committee. Can you still hear me, Toby?
Yes.
Sorry, my screen's just dropped out.
Ah.
I don't know if we've got a tech problem here. So we look at the makeup of the existing investment committee. If they don't have an investment committee, we do ask them to work with us on who will be providing input into that committee. And if it's just the founders or financial advisors of the business, we're pretty clear that third-party participation around manager selection, if they're using fund managers, and asset allocation and those sorts of things is required. And so the governance of an investment committee is something we also help with. We also come up with the charter for the investment committee, how it operates, what its mandate is, who makes decision making, who votes, and those sorts of things. So it's a pretty structured approach to what we think is the investment grade investment committee for portfolio management.
And Nick, what about you? I mean, you're structured as an MDA provider, and so just as Ironbark are the RE, you as MDA provider, I imagine.
Yeah, look,
responsibility.
Yeah, we do much the same. I mean, when an investment manager or a financial planning practice comes to us and sort of starts going through the process, investment management group is probably easier because we can obviously clearly define there's no conflict because they're not the ones advising the clients. They're just purely running the model portfolios. We still run them through a quite rigorous questionnaire answer program and follow-up meetings just to make sure that they do have the skills and expertise to manage portfolios. It's not as if we'd add on like the Nick Avery portfolio tomorrow sort of thing. It was more that they have to have, a track record of managing money, portfolios. And we are sort of looking at those sort of names like Lonsec, etc., that have, long-standing track records in the industry.
Now, when we worked together, you told me that the Nick Avery portfolio always shut up.
Maybe not through the current pandemic, but
let's talk about the vexed interest of remuneration, because it's been something which has been a continuing issue for managed accounts. For either of you, what's the attitude of your organisation to advisors charging portfolio management fees, or do you have a process which supports this? There are obviously costs of running managed accounts.
Yeah, look, we're sort of, it's been a very interesting one, and one that's sort of attracted quite a bit of attention inside our business. Given that we're actually also the ASX market participant, we have to be very careful to sort of remove the conflict associated with something that might be considered churning from an advisor or someone running an investment management piece. So we give the end advisor or dealer group the actual decision. They either charge the investment management fee and zero brokerage. Finclear will charge because we have an execution cost, which is ASX fees, etc. But they cannot actually charge additional brokerage, which then removes that conflict from a transactional perspective. So if the client does 1 trade or 20 trades, there is no end benefit to that advice group. Or if they don't want to do that and they want to simply charge brokerage, they're not suited for a managed accounts model, and they need to sit on the outside and do the proper process of SOAs, ROAs, etc.
Chris, what about Ironbark's approach to remuneration and revenue?
Yeah, so I think as a general guideline, we would say to advice businesses that you should generate your fees from clients as an advice fee. And while in the past managed accounts may have been set up where the advice practice might have generated revenue directly from the managed account, broadly, we're in a space where we think if you're running a managed account, advising clients and collecting a fee for advice, collecting a separate fee, whether disclosed or not, from a managed account will become more problematic in the future. So if you were setting up a new one today, we would say to you, look, set this managed account up. Don't take revenue from this managed account. You will achieve significant cost savings typically for the clients. You might achieve a saving of sort of 30 basis points as an example on a balanced portfolio. you can pass that on to the clients, or you can use this as an opportunity to increase your fees a bit so that the total cost to client might still come down, but advice fees may go up. We think that's a more sustainable model when it's transparent.
Okay, but before I come to, there's a question here, Nick, for you, which sort of goes back to the point we were talking about earlier on with capital raisings, and that is with placements. I mean, obviously, as a member of the exchange, you would often be entitled to participate in placements. How does Finclear deal with that?
Yeah, look, I mean, within the managed account structure, and again, I'll just revert back to sort of the Lonsec models that we use as well. So they're predominantly sort of ASX 200 to 300 models. So yes, there are placements, there are capital raises. It greatly depends on the distribution of those capital raises. So a lot of them, they might come to market quickly. They might be wrapped up quite quickly. They might already have support that'll just sort of take out anything there. But if we're talking about renounceable rights issues or, SPPs and that sort of stuff, we have the ability to actually apply for those, given we are an ASX market participant, back and directly for those advisors. But when it comes to the other sort of more known sort of wider placements that are larger and more sophisticated, we do have sort of connections into larger investment banks and brokers where we can get distribution of those placements and IPOs and feed them back into our clients.
All right, so finally, let's wrap up by just talking about your respective views of MDA versus SMA. Obviously, one of you is an MDA provider, the other is an SMA RE. Do you have a view on the relative benefits of either structure, other than the one that you actually participate in? Yes, that's right.
Yeah. Look, our view on SMAs is, it depends a little bit on your business strategy, which is how much are you going to grow? Do you need to run all the clients on one platform or multiple platforms? And what is your investment philosophy? So, our clients are typically people that use fund managers in the main. And so they might come to us with a range of fund managers that they want to manage on an ongoing basis, change on an ongoing basis. And if they're growing their business by acquisition, they're going to acquire clients who may be on other platforms. And running an SMA allows us just to pick up the investment model and drop it onto different platforms. It doesn't require platform migration. So that's where we think the SMA fits well.
Right. All right. Thanks very much. And Nick, what about yourself?
Look, obviously we're MDA, first and foremost. Obviously, difference between MDA service, SMA almost product. So our view is SMAs obviously require an advice business to actually have a set amount of fund they would probably set up to actually cover the establishment costs and all the ongoing costs, especially when it comes to the RE, trustee structures, etc. PDS provisions, etc. So our solution is probably doesn't require that initial sort of fund balance per se to get over the line initially if you wanted to set it up and grow it sort of organically over a period of time.
Look, Chris, Nick, thank you very much for the time you've taken today. It's been interesting for us to have a chance to talk to two such different protagonists about managed accounts.